the lesson. If we have a system in place which has integrated processes that themselves have fast-moving parts that require constant attention, then that system almost certainly requires some form of mechanism for control and balance. Now think about our systemic approach to the financial crisis, and think about the three nodes in the form of the investment banks, SPVs, and the repo market. The repo market was providing the balance, or if you liked, was performing a balancing act for the whole system. The repo market was the efficient control and the friend of the system, but at the very moment the system needed that control and balance, the repo market became the detonator. More pointedly, the repo market and its refusal to continue to finance assets, even for very short periods, which it considered potentially worthless, led to a catastrophic change in the system. In fact, it led to an evaporation of confidence in banks and between banks. And one final point I'd like to make before we move on is this, that we really should put a name to the fate of the repo market. I mean, what right did this market have to withdraw confidence and liquidity? Well, the problem was, and still is that the repo market is none other than the banks themselves. The evaporation of confidence in banks led to an evaporation of confidence between banks, which led to an evaporation of confidence in banks. The control mechanism became the detonator. Just looking back at our systemic diagram, one of the connections with investment banks reads that investment banks innovated credit product. One artifact of that innovation is this, that the speed with which sticky long-term lending, such as mortgages, could become shaped into a commodity that could very easily be purchased and passed on is the following. The ability to take loans and convert them into securities, which could be sold, facilitated much smoother and quicker transfer of risk. And in addition, the tailoring of that product through tranche technology allowed a new array of securities to be created, which would suit a plethora of investor tastes, which of course further encouraged investor participation and created new waves of demand for credit product. In some senses, of course, we could conclude finding long-term investors to purchase long-term loans did what should have been done, matching long-term liabilities with long-term assets. This surely was better than relying on the short-term nature of the repo market. Now that would be fair as an observation. However, there was another frailty in the system here, almost certainly not perceived when these securities were being created in the mid-noughties. The frailty could be summed up as model risk. Now, during the creation of credit product, from very simple examples whose values depended only on a single variable, to much more complex structures which depended on financial calculus, models had been developed hand in glove with the product. And the purpose of these models was foremost to take observable market variables in order to calculate consistent valuations for products which could not otherwise be observed in the marketplace. In other words, the legal and structural process of converting sticky, long-term loans into securities, which could then be bought and sold, needed to have a framework which gave confidence that the valuation and therefore the liquidity of these products could be upheld during different market conditions. In turn, that supported the ability and the willingness of the repo market to finance those securities. The valuation technique and the values themselves were clear, they were manifest. Furthermore, given that this modelling could be carried out by credit rating agencies, these agents themselves could then ascribe credit rating and default probabilities to these securities, using the same or similar models. Now, on top of this, credit insurance companies themselves, rated by credit rating agencies, could enhance the products by promising to stand behind them in different market conditions. The innovation, design, modelling, rating, wrapping, distribution and financing process was now complete. Clearly, the underlying loan, the bank, the rating agency, the credit insurer, the finished product, the investor, could be anywhere on the globe. And the interdependency and the speed with which more interdependency could be created was pushing ahead at pace. From this point, there is no doubt that globalization had made the banking system more connected and more interdependent. However, a scientific analysis of how much more connected it was in 2008 versus, say, 10 years earlier is not something we're going to focus on today. Instead, what we've chosen to do is to simply accept this interconnectedness, the blossoming and innovation of credit products, and the reliance on repo markets. Interconnectedness, innovation, and reliance on the belief in interconnectedness and innovation was the story of the run-up to the crisis. And closer analysis of the systemic nature of the institutions and their interconnectedness, particularly around the willingness and the ability to finance each other, proved to be the trigger to the evaporation of confidence in banks and between banks during the crisis. The balancing act around stability and equilibrium could only last as long as the whole believed in the parts.